Okay, let's unpack this one. Imagine a company that not so long ago literally changed the course of a global pandemic, became a household name basically overnight. They were heroes, their stock went through the roof, seemed unstoppable, right? Now, fast forward to today, and that same company's stock is trading at a significant discount. We're talking around $25.83 a share as of September 18th, 2025. Some investors are looking at it thinking, compelling risk reward maybe, a potential steal, while others, they see massive, maybe even insurmountable challenges ahead. So, what exactly is going on? Can this revolutionary mRNA platform generate sustainable long term value? Or was that monumental pandemic success just a fleeting moment of brilliance, something that, just can't be replicated? That's the core question we're diving into today as we explore Moderna Inc., ticker NASDAQ mRNA. Our mission, like always, is to give you a shortcut, help you get well informed about Moderna's really complex journey, pulling out the most important insights from, well, a whole stack of sources, so you can walk away with a much clearer picture.
Yeah, what's truly fascinating here is that we're looking at a company at a really critical inflection point. Its story isn't just about, the amazing science and rapid innovation anymore. Now it's fundamentally about commercial execution. It's about financial discipline and navigating the inherent huge risks of biotech. This deep dive, we're going to pull back the layers, connect its past triumphs to what is, frankly, a very uncertain future, and try to understand if its biggest achievements are still ahead or, well, if we've already seen its peak.
Okay, to really grasp Moderna's current state and where it might be headed, we need to start with the foundations. Let's dive into its core business, the leadership, and, of course, the hard numbers. Let's kick off with Chapter 1, business analysis. Beyond the pandemic pivot, the core insight our sources really highlight is that the central question for investors isn't about those past glories, but about Moderna's ability to navigate this, well, challenging post-pandemic reality. Its business model has had to evolve incredibly fast. From a single product, pandemic driven company to something more like a traditional, though, technologically advanced biopharma company, their stated mission is deliver the greatest possible impact to people through mRNA medicines. Okay. But today, their revenue streams are still heavily dominated by the respiratory franchise. That's the COVID vaccine, Spikevax, and the newer RSV vaccine, mRESVIA. And wow, what a shift in revenue from a peak of over $19 billion in 2022.
19 billion, incredible numbers.
It just plummeted to $3.2 billion in 2024. And for 2025, projections are even lower, somewhere between 1.5 and $2.2 billion. This isn't just a dip, right? It's a fundamental shift from that pandemic cash machine to, well, a traditional biotech fighting for financial runway. Future growth is almost entirely dependent on pipeline success.
Exactly. And if we connect this to the bigger picture, their future absolutely hinges on what's coming next down that pipeline. So let's look at their key products and services. Commercially, Spikevax, as you said, is transitioning. It's becoming a seasonal vaccine. Q2 2025 sales were $114 million. Then there's mRESVIA, approved in 2024 for adult 60 plus. That was a crucial diversification step, no doubt. But sales in the first half of 2025 were described as negligible.
Negligible. Ouch.
Yeah, signaling slower than anticipated adoption. But here's where it gets really interesting. Their late-stage pipeline, Phase 3. That's the core of their future value. This includes a seasonal flu vaccine, mRNA 1010, efficacy data expected this year, 2025. A flu plus COVID combo vaccine, mRNA 1083. That's a key strategic priority. Think convenience, broad uptake.
Makes sense.
Then there's the cytomegalovirus, or CMV, vaccine, mRNA 1647. Also expecting final efficacy data in 2025. Huge unmet medical need there. And the big one, potentially, the individualized neoantigen therapy, or INT, mRNA 4157. That's the partnership with Merck for melanoma and non-small cell lung cancer, NSCLC. Could truly be a paradigm shift in oncology if it works out.
So a lot riding on those trials.
Absolutely. Now, in terms of market position, Moderna is a pioneer, a leader in mRNA tech for sure, but its commercial scale, it's pretty modest compared to giants like Pfizer. Its market cap is around $10 billion right now. That's a huge contraction from over $100 billion at its peak. Just shows you the market recalibration. Ultimately, the primary value proposition is that proprietary end-to-end mRNA platform technology. It offers faster development, immense flexibility, and the ability to target these undruggable diseases. Like Vax's rapid development, that's the ultimate proof of concept for the platform's power.
Okay, so the platform is revolutionary, like having this, I don't know, advanced toolkit for medicine. But how does that scientific edge hold up against the market itself, the trends in the mRNA space? Because the global mRNA therapeutics market is actually shrinking right now, from about $8.9 billion in 2024 down to what's called a trough year of roughly $6 billion in 2025. That's mainly the declining COVID vaccine demand. That's a big contraction.
It is. It's significant.
However, the long-term outlook, the sources say, is robust. Strong growth projected post-2025, maybe reaching over $21 billion by 2032. That's almost a 20% compound annual growth rate, or CAGR, so growing nearly 20% year on year on average. And that growth is expected to come from things like personalized cancer vaccines, expansion beyond infectious diseases. Just the flu RNA vaccine market alone is valued at nearly $2.8 billion in 2025, growing at over 11% CAGR.
Which leads us right to the next question. Who are they actually up against? Because the competitive landscape is, well, fierce. Direct mRNA competitors. You've got BioNTech, obviously partnered with Pfizer and CureVac. Yep. Then you also face the global pharmaceutical giants. Pfizer, Merck, J&J, AstraZeneca. These companies have an immense scale, huge R&D budgets.
And deep pockets.
Deep pockets, exactly. Even alternative vaccine technologies like Novavax, they're vying for market share too. The regulatory environment, it's a bit of a mix. You've got tailwinds like the FDA and EMA embracing innovation with streamlined pathways for advanced therapies. That's good. But there are headwinds too. Strict rules, lengthy delays for non-pandemic vaccines. That remains a challenge. Plus, there's this new EU health technology assessment, the HTA regulation, starting in 2025. Adds another layer of evaluation, especially for oncology and advanced therapies.
Another hurdle.
And the barriers to entry. Exceptionally high. You need the scientific and technical complexity figured out, making the mRNA stable, perfecting delivery like those lipid nanoparticles, LNPs. There's a dense web of intellectual property patents. Manufacturing scale-up needs to be GMP compliant, super capital intensive. And then clinical trials and regulatory approvals cost hundreds of millions, sometimes billions.
So, with all those challenges, what's the real edge for Moderna? What truly gives them a leg up that competitors can't just copy? Our sources point to brand strength, first off, exceptionally high recognition from COVID-19. But that creates this kind of pandemic paradox, fame tied to an emergency product. Future growth has to come from traditional markets. It's not just about people knowing the name, it's about convincing specialists, payers, doctors in a crowded field. That takes a whole different kind of commercial muscle.
Right, they're building that now.
And cost advantages, they don't really have significant ones right now. They're actually experiencing negative gross margins because of inventory write-downs, unused factory capacity, the potential for future platform-based cost efficiency, leveraging the tech. That's not realized yet. Network effects. Minimal for now. Maybe a weak one could emerge if combo vaccines become the standard, but that's speculative.
So what's left?
Their most powerful advantage, really, is that unique end-to-end mRNA platform, an integrated system from research right through to advanced manufacturing. SpikeVax proved it works, and fast. And their pipeline, it's extensive, diverse. We mentioned the big ones, but there's stuff for norovirus, EBV, Lyme disease, even rare diseases like propionic acidemia, methylmalonic acidemia. It's all a direct result of that core capability. It's like having a universal engine for drug development.
A powerful engine, but needs fuel.
Exactly.
Which brings us to the people steering the ship. Let's shift focus now to Chapter 2. Management Evaluation. Stewards of a Scientific Revolution. Stefan Bancel, the CEO since 2011. He led the company through the ultimate crisis, a global pandemic. That's a monumental achievement, no question. But now he faces a completely different kind of crisis, shifting from that emergency growth mode to sustainable, long-term commercial success. It's a different game.
Indeed it is. And their response to this post-pandemic revenue collapse, it's been decisive, maybe even aggressive. We're seeing significant cost cutting. There was a 10% workforce reduction announced mid-2025, and a sharp prioritization of the R&D budget towards those late-stage assets we discussed. It signals a real shift from that growth-at-all-costs mindset during the pandemic to disciplined capital preservation now. Bancel's background, at bioMérieux and Eli Lilly, that gives him broad industry perspective, which is pretty crucial right now.
Makes sense. Now, it is worth noting their ethical reputation took some hits during the pandemic. There was scrutiny over vaccine pricing, global access. Remember that 2023 Senate hearing?
Vaguely, yes.
Bancel's justification for quadrupling the COVID vaccine list price drew significant criticism. That history isn't just, a past issue. It creates reputational headwinds, could influence future government deals, public trust in new mRNA products, even pricing discussions down the line.
That's a really critical point to remember. So with these challenges, this renewed focus on discipline, what does it all mean for how they're investing in their future? How are they allocating that precious capital? Our sources indicate the primary focus is still internal R&D. but even that's being trimmed back. The 2025 R&D budget is projected at $3.6 to $3.8 billion, down from an earlier $4.1 billion estimate. It's described as a high-stakes barbell strategy. You've got the predictable, maybe lower growth respiratory cash flow on one end, funding the speculative, high-potential assets like the personalized cancer vaccine on the other. It's a big bet.
A calculated gamble, perhaps.
M&A, mergers and acquisitions, doesn't seem to be a primary strategy. They seem to favor strategic partnerships, like the one with Merck for the INT cancer vaccine. Share the costs, share the risks. No history of dividends, which is pretty typical for biotech at this stage. There were some past share buybacks, but Q2 2025 actually showed negative buybacks, likely share issuance for employee compensation.
So holding on to cash.
Exactly. Current focus. Cash preservation, and not surprisingly, their return on invested capital, ROIC, deeply negative right now, somewhere between minus 28%, minus 40% over the trailing 12 months, TTM. Simply means for every dollar they're investing, they're losing money currently. Stark contrast to the pandemic profits. The whole strategy now is aimed at reversing that trend, hopefully by 2028.
2028, still a ways off.
It is. Okay, let's really get into the hard numbers now. Let's move to Chapter 3, Financial Analysis. A company in transition. Moderna's financial profile, it's truly a story of extremes, a classic boom and bust cycle playing out. Their market cap is around $10 billion now, makes it a mid-cap biotech, just a shadow of its former peak valuation. The revenue growth figures, they really tell the tale best. From $803 million in 2020, explodes to that peak of $19.26 billion in 2022, then plummets. $3.24 billion in 2024, and for 2025, projected between $1.5 billion and $2.2 billion. It's almost like you have to treat it as a new company from 2023 onwards, given the scale of the reset.
Absolutely. And that revenue story flows directly into profitability or lack thereof. It's a stark picture. Profit margins have just collapsed. In Q2 2025, get this, the cost of sales, $119 million, actually exceeded net product sales of $114 million, resulting in a negative gross margin.
Wow, costs more to sell than they make from the sale.
Essentially, yeah.
Yeah.
Due to inventory write-downs, unutilized capacity, like running a huge factory almost empty, as you said earlier, operating and net profit margins. Also deeply negative. We're talking a shocking minus 581% net margin for Q2 2025.
Just staggering numbers on the downside now.
And free cash flow mirrors this collapse.
Yeah.
From a peak of generating over $13 billion in cash in 2021, they swung to significant cash consumption, burning through cash. Over $3.8 billion burned in 2023, over $4 billion in 2024, and just in Q2 2025 alone, they burned through over $660 million. They're actively burning through those reserves built up during the pandemic just to fund operations in the pipeline.
Wow, a negative gross margin. That really just highlights the severity of this transition phase, doesn't it? So, with negative cash flow, negative margins, how stable is the company financially? Can they weather this storm? Our sources suggest earnings consistency is, well, highly inconsistent and negative. EPS peaked at over $20 in 2022, now projected at minus $9.70 for 2025. Profitability, not expected until 2028, according to estimates. However, and this is a crucial positive, their balance sheet is strong. Debt-to-equity ratio is exceptionally good at 0.28. They're effectively debt-free.
That's key.
It is. The primary risk is the operational cash burn, not debt hanging over them. And their current ratio, which measures short-term liquidity, excellent at 4.22. They have about $6.2 billion in current assets versus only $1.6 billion in current liabilities. This robust balance sheet, built up during those profitable pandemic years, is the crucial wedge. It's what gives them the runway for pipeline development. And as expected for a biotech, dividend stability isn't really applicable. No dividends expected anytime soon.
Okay, so given those financials, the usual valuation metrics like PE are kind of useless, right? Negative PE isn't meaningful. But other metrics give some clues. Price to book, PB, is around 1.03. That's similar to BioNTech, actually lower than Pfizer. It suggests the market is valuing the company near its net asset value, basically, the value of its stuff minus its debts, assigning very little premium for future growth potential.
So the market's basically saying, show me the results from the pipeline.
Pretty much. Price to sales, PS, is 3.16, higher than Pfizer's, but lower than BioNTech's. So how do we value a company like this? So much future potential, so much present pain. We use a discounted cash flow or DCF analysis, specifically a risk-adjusted net present value or RNPV model. It's common for biotech. It estimates intrinsic value by projecting future cash flows from each pipeline drug, but crucially weights them by their probability of actually succeeding and getting to market.
Factoring in the risk.
Exactly. Our educational model, using these principles, suggests an intrinsic value range for Moderna of $35 to $50 per share. Now, this is highly sensitive to the success and commercial uptake of those big pipeline assets, particularly the oncology and CMV programs. They are the largest potential value drivers in the model. Key assumptions we used: a 2.0% terminal growth rate and a higher-end discount rate of 12%. That higher rate reflects the significant risk in Moderna's pipeline-dependent future. And for those phase 3 assets, we applied a 60-70% probability of success, which is fairly standard but still carries risk.
Okay, $35 to $50 range based on the model compared to the current $25-ish. Interesting. Now let's shift our focus outward. How is the market perceiving Moderna? Who owns it? What are the big risks on the horizon? We're moving into part 2, external forces and the path forward market ownership, risk, and conclusion. Kicking off this section, let's look at chapter 4, market sentiment. So we've got the internal picture. Now, how is the market reacting to all this? What's the feeling among analysts, investors?
Well, analyst sentiment is decidedly mixed, maybe leaning cautious. The consensus rating is hold. Among 24 analysts covering the stock, you see 5 buys, 15 holds, and 4 sells. And look at the price targets, they're all over the place.
Really? Like how wide?
Extremely wide. The one-year targets range from $15 on the low end to $207.90 on the high end.
Wow, that's huge disagreement.
Massive disagreement. Underscores how tough it is to value this company right now. The average target is around $44, $47, which suggests some upside from today's $25.83. But interestingly, recent targets from some major banks are more conservative, clustering more in the $25, $31 range, closer to the current price, the media narrative. It often focuses on that post-pandemic fall from grace, consistently highlighting the sharp revenue declines, the cost-cutting. It's often framed as, near-term pain versus long-term hope, contrasting the disappointing financials with the pipeline progress. And management's guidance, which they often describe as conservative, has frequently hit the stock negatively.
Okay, so mixed analysts, cautious media. What about the hard market indicators? What do they tell us about investor confidence or lack thereof? Short interest is exceptionally high, 16.47% of the float, with about 4 days to cover.
That's really high.
It is. It indicates significant bearish sentiment, makes Moderna a real battleground stock. Lots of people betting against it. And looking at its price relative to moving averages, the stock's trading below both its 50-day moving average, which is around $28.47, and its 200-day moving average, around $31.65. That indicates bearish trends in both the short term and long term.
Not a pretty technical picture then.
Not right now, no. Okay, next, let's consider Chapter 5, ownership structure. Who actually owns a piece of this company?
Yeah.
Sometimes that tells you a lot about commitment and dynamics.
Right. Top institutional ownership. It's dominated by the big passive index fund managers. The Vanguard Group holds about 10.7%, BlackRock has 5.1%, State Street 4.4%. This provides a stable base of ownership, but it's passive money. It doesn't really signal strong conviction either way.
Just tracking the index.
Exactly. What's more interesting is the mixed sentiment among the active managers. You see growth investors like Bailey Gifford and Fidelity, they've been reducing their stakes recently. But then you have opportunistic hedge funds like Millennium Management and Two Sigma. They've been aggressively adding to their positions.
Huh. So different bets being placed by the smart money.
Precisely. Points to a really diverse set of expectations for where the stock is headed. Now, regarding insider holdings, CEO Stefan Bancel holds a significant 5.5% stake. That definitely aligns his interests with shareholders. While there have been more sell transactions than buy transactions in the last 12 months, about 40 sells versus 5 buys, much of that selling appears to be related to tax obligations from stock options. That's pretty common for executives.
Okay, so not necessarily signaling a lack of faith.
Not necessarily.
Right.
And encouragingly, there have been some open market purchases by insiders recently. Director David Rubenstein bought some. CEO Bancel himself bought some shares on the open market. That does signal some belief in the long-term prospects.
Good to see. And ownership concentration.
Not overly concentrated. It's a broad base, which provides good liquidity for the stock.
All right. Now, for a crucial part of any investment analysis, the risks. Every investment has them. And for a biotech like Moderna, they can be substantial. Let's break down the strengths, weaknesses, opportunities, and threats in Chapter 6. Risk assessment.
Yeah, the classic SWOT analysis. Let's start with the fundamental strengths. What does Moderna have going for it? First, obviously, that pioneering mRNA platform, validated by the pandemic response. It's world-class tech. Second, a strong balance sheet, around $7.5 billion in cash, minimal debt. That financial runway is absolutely crucial right now. Third, high brand recognition globally. People know the name Moderna. And finally, that deep, diversified late-stage pipeline we talked about across oncology, infectious diseases, rare diseases, lots of potential shots on goal.
Okay, those are significant strengths. What about the flip side, the weaknesses?
They're pretty clear, too. Extreme revenue concentration on those declining respiratory vaccines, especially Spikevax. Deeply negative profitability and cash flow right now, with no clear path to breaking even before 2028 based on current projections. Limited commercial experience outside of those big government pandemic contracts. We saw that with Mresvia's slower uptake. Selling into the regular market is different. And finally, just smaller scale compared to established big pharma. Less marketing muscle, less negotiating power, perhaps.
Right. So strengths in tech and pipeline, weaknesses in current financials and commercial execution. What about the external opportunities?
The opportunities are also significant. Potential for multiple blockbuster product launches from that pipeline, INT, CMV, the combo flu COVID shot. Any one of those hitting big would be huge. The overall mRNA therapeutics market, despite the current dip, is projected for strong growth long-term. Remember that near 20% CAGR post-2025. There's also the potential for platform expansion into totally new therapeutic areas, like autoimmune diseases. They're exploring that. And the chance to potentially dominate seasonal respiratory vaccines with convenient combination shots. That's a big strategic goal.
Okay, lots of upside potential if things go right. But the threats, what could derail this?
The threats are formidable. Intense competition, as we discussed, from biotech, Pfizer, other mRNA players, and big pharma. The binary risk of clinical trial failure. This is huge in biotech, especially for high-profile assets like the INT cancer vaccine. A major failure there would be catastrophic for sentiment and valuation.
Absolutely critical trials.
Critical. Regulatory hurdles and potential delays are always a threat. And lingering public perception challenges, things like vaccine hesitancy, could hamper uptake of new products, even if they are approved.
Okay, so beyond those direct industry factors, what about the bigger picture? Macroeconomic trends, geopolitical stuff. How does that impact Moderna?
Well, macroeconomic factors definitely play a role. High interest rates make capital more expensive. They also increase the discount rate used in valuations, which inherently pushes down the calculated intrinsic value of future earnings. Persistent inflation increases R&D costs, manufacturing costs, further pressuring that cash burn and potentially shortening their financial runway. They act as headwind amplifiers, basically making existing problems worse.
Makes sense. Geopolitical factors are relevant too. The U.S. imposed tariffs from 2025 10% on many imported goods, but up to 245% on certain Chinese APIs, active pharmaceutical ingredients. Those APIs are the core components of drugs. That poses a direct threat to the whole pharmaceutical supply chain. Now, Moderna stated back in Q2 2025 that they didn't expect the tariffs to have a material impact on them specifically. But, these things can change. It could potentially increase production costs down the line, squeezing those already negative margins. Something to watch.
Definitely something to keep an eye on.
Okay. We have covered a lot of ground today. Looked at Moderna from pretty much every angle. Now, let's bring it all together, summarize our findings. Time for Chapter 7. Conclusion. What's the bottom line here?
Yeah, the analysis really paints a picture of a company at a critical inflection point. The investment case is starkly divided. It's very much a bull versus bear story. The bull case, it rests squarely on that world-class, validated mRNA platform and the massive potential in that late-stage pipeline. Think personalized cancer vaccines, CMV, the combo respiratory vaccines. Any of those could be multi-billion-dollar products. Critically, they have that fortress balance sheet, significant cash, virtually no debt. That gives them the runway, the time needed to fund this next wave of products. And at $25.83 a share currently, it's trading at a deeply depressed valuation near its net asset value. Suggests the market isn't really giving much, if any, credit for that multi-billion-dollar R&D pipeline right now.
So the bulls see potential value being ignored. What about the bears?
The bear case is grounded firmly in the severe present challenges. Moderna is experiencing massive cash burn, losing billions annually. No clear path to profitability until 2028 at the earliest, according to estimates. There's significant commercial execution risk. We saw the slower than expected uptake of the RSV vaccine, mRESVIA. Can they successfully launch and sell these new products in competitive markets? That's a big question mark. And the binary clinical risk is immense. A failure in a major trial, particularly the INT cancer vaccine, that would be catastrophic for the stock, absolutely devastating. And all of this is compounded by that intense competition from larger, better-funded pharmaceutical companies who are also racing in these same areas.
A clear split then. Huge potential, huge risks. So back to our educational risk-adjusted DCF model, what did it tell us about intrinsic value, factoring in those probabilities? You mentioned a range.
Right. Our model suggested an intrinsic value range of $35 to $50 per share. Again, heavily dependent on successfully commercializing at least two major pipeline assets. That's a key assumption baked in.
Okay, so as of September 18th, 2025, Moderna's share price, around $25.83, trades at a significant discount to even the lower end of that estimated intrinsic value range. This suggests the market is pricing in a pretty high probability of pipeline failure, or is perhaps overly pessimistic about their chances. While the risks are substantial, absolutely undeniable for long-term investors out there with a high risk tolerance and a strong belief in the underlying mRNA platform,
Yeah.
the current valuation may represent an attractive entry point. Big emphasis on may and high risk tolerance.
Definitely. The ultimate question for Moderna, and really for any truly disruptive company that has a moment like they did, is can that scientific triumph, born from an extraordinary crisis, successfully transition into a sustained commercial enterprise? Can it truly revolutionize medicine beyond the pandemic? Or was its moment of unparalleled brilliance, that incredible peak also? Its peak, that's really something to mull over.
It certainly is a fascinating story wherever it goes next. We hope this deep dive into Moderna has given you, our listener, a clearer, more nuanced picture of a company really at the precipice of its next chapter. If you want more insights like this, covering companies in depth, make sure to like and subscribe to Stock Analytics AI. Our $4.99 a month members get priority deep dives on tickers they request, and over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access to those deep dives. If you just want a one-off deep dive on a specific company, you can always drop us a super thanks. We appreciate the support. Now, before you go, the quick but very important disclaimer. This analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice. Please always conduct your own research or consult with a qualified financial advisor before making any investment decisions.